Okay, so headline CPI, that's the number we're waiting for.
It's a big one.
Later on this week, yeah.
The big one this week. I mean, we've also got retail sales, but I think it's safe to say the consumer, at least in the near term, has cash and will spend it. So I think the retail sector's doing okay at the moment. Inflation, however, is there going to be a surprise to the number? We saw a downside surprise in the February print to 6.1. Now, what we're expecting is a rise to 6.2. But here's the thing. Consensus thinks it's going to go to 6%. So what we'll be watching very closely in the data is, well, are our forecasts correct that inflation's actually going to rise? And why do we think we've got a rise priced in? Well, I know food inflation has surprised to the downside for 2 consecutive months. We still think there's a little bit of momentum left within that number. Strip out food inflation, what else do you have left? Core inflation. Well, core inflation we expect to rise just a little bit further. It's already gone to 4.3. We think it's going to go to 4.4. Why is this? I think it's safe to say that if you had to speak to any of the listed retailers, you'll have seen that in most of the recent results presentations, big signaling going on that prices will be passed on to consumers. On average, in 2011, listed retailers, clothing and merchandise, inflation ran at about 3%. The signaling looks like it's going to take it to about 7–8%. So I think core inflation is something one should watch through 2012 and something that is certainly going to be rising further. It makes sense. We've had 2 years of very strong consumption growth. Think what the consumer is telling the retail sector.
Things are looking good, although despite that, I've actually spoken to quite a few retailers, footwear retailers in particular, saying that first quarter growth much softer than what we saw last year. And on that note, we're also waiting for retail sales to come through. And it's interesting because consensus is sitting at around 4.7%. The previous number was 3.9%. It's quite a strong number. I mean, what if it disappoints to the downside, Gina? Then what does that tell you?
If it disappoints the downside, it means perhaps the consumer is starting to think about, well, first of all, inflation is rising, so eating into that nominal income pie of theirs. But secondly, perhaps the consumer is looking ahead and thinking, well, if inflation is going to rise and everyone's talking about potential rate hikes in South Africa at some point, perhaps confidence is starting to waning a little bit. But I really don't think that's the case. I think if there's one thing we know about the South African consumer, when there's money left over in the pocket at the end of the month, it gets spent. And I think what we're seeing on the credit side of things, sure, nothing exponential on the headline number, sitting around 6–7% for overall credit extension. But if you start drawing down into the breakdown, I know there's a lot of talk around unsecured lending at the moment, and that's
also certainly, this is exciting, Eugenia.
Certainly growing a lot of momentum, and I think some of that feed through could at least, if not going straight into the retail sector, at least help to offset some of the debt burden that consumers are facing, and hence make them feel a little bit better about spending more. I think 2012 for the consumer is okay, because we are not expecting, and just going back to the inflation number, we're not expecting inflation to go above 7%. We think it will rise from here on, but it's likely to peak just below this, around 6.8% come the second quarter. Thereafter, it starts to taper down. But now the concern for rates is really that it tapers down, and the Reserve Bank sees it going back within the target band in the beginning part of 2013, much like we do. But it stays there. That's the problem. It stays right at the top of the band, around 5.8%, maybe going down to 5.5%. Nevertheless, not very far off from getting back out that band. And if this economy ends up okay, or the consumer ends up with even more upside to it.
So when you say okay, are we looking at growth of like just above 3%, Gina? Because that's not great.
Well, okay means around 3%. But where the concern would come from growth is the composition. If it's being driven by a consumer that keeps powering ahead and keeps spending and spending, and core inflation starts to rise further and further and further, at some point the Reserve Bank's going to have to step back and think, is it now inappropriate to have policy rates as low as they currently are?
Just to interject there, markets officially closed in South Africa. We're down 33 points, flat, slightly to the negative, 33,671. And on that note, I mean, one of the reasons that we are in negative territory today, Gina, is the fact that we're really focusing on these Spanish bond yields that are above 6% once again. How closely are you looking and monitoring the European situation as to a clue, as, you know, in terms of what could happen from an economic perspective here in South Africa?
Well, we're still expecting a mild recession in Europe, something in the very low numbers in the negative territory, that's for sure. I think what's saving South Africa is the fact that the US economy is certainly looking to be tracking, according to our estimates, around 2.7% GDP for this first quarter. I think those retail sales numbers that came out today certainly not only to the upside, but help to show that there is somewhat of a cyclical recovery taking place. On top of that, The other positive for South Africa is the fact that Asia, even though the Chinese GDP numbers on Friday disappointed, they're still strong enough to at least create somewhat of a demand for both our manufactured exports and then, of course, very importantly, for mineral exports from South Africa. Put this all together, what does it mean? It means that as far as exposure goes, South Africa has no doubt got a big exposure to Europe. It's 30% of at least the manufactured exports out of this country. But if you combine Asia, the rest of Africa, and then the US, you're talking about something well into the 60% of exposure, which we believe is going to keep the manufacturing sector, once again, the word okay. It's not going to go into decline necessarily. It's not going to shoot the lights out. Maybe around 3%, maybe we'll be lucky 5%.
So you're using this word okay
growth.
quite a bit, so I'd like to use it as well, just to reiterate some of the points. We're looking at an interest rate cycle which is at 30-year low, 5.5% on the repo rate. And we're looking at inflation being at an okay level, just very close to the 6% level in the beginning of next year. When we do see a rate hike at some point, are we going to see a significant rate hike in a very short, various rate hikes in a significantly short space of time? Are we going to see a normalization? And has the word normal now changed completely?
We think that it will be a normalization process, which is very different from chasing inflation. So in other words, inflation will seem behaved because it will pop just back into that target band. But of course, the concern will be that if growth is okay and if there's any undue consumer pressure leading into demand-led inflation, well then you've got to at some point move this economy from negative real rate territory back to some form of a neutral rate. Now, to answer your question, we don't think it's going to be a very quick cycle. Yeah. We do think the SARB's going to normalize rates starting in November with 50 basis points. But thereafter, we're only pricing in 200 basis points in total over more than a year. So literally 50 basis points at every second meeting. That's where the forecast risk lies. Will it be at every second meeting?
Yeah.
Well,
that
probably
like
not.
Bit of pain for the consumer.
They're not going to be perfect at every single second meeting doing it. They're going to watch the data and they're going to make sure that the economy can handle it. I think that's the key to interest rates going forward.